Or pitchers for the Yankees. And Messina. You guys are too young to remember Messina. Okay. So the quizzes are still up there. I will leave them till Friday, and then I have to bring them in simply because the MBA quizzes are next Monday, so I don't want the mess to be created. But for the most part, you guys did well. The couple of things we talked about during the last class about adjusting the payout ratio. That's something that almost has to become second nature. When you do terminal value, you have to stop and check every number because you're locking everything in forever, and you want to make sure they're internally consistent. Incidentally, I haven't finished the DCFs yet. Something else got in the way. I had to travel yesterday, so I'll try to get them by the end of the week. But as I said, you're not dying to get back to DCFs, I would think. But let's start today's class with a question about what's coming next. Today, towards the end of the class, we're going to do a pivot away from intrinsic valuation to pricing. Right? So here's the first part of the pivot. Okay? If you're valuing a commodity company, is it impossible to value a commodity company without taking a point of view on... So today, for instance, we're going to value an oil company. And when people value oil companies, they say, it's impossible to value an oil company without taking a point of view on oil prices. Is that true? Can you value an oil company without taking a point of view on oil prices?
No, you can be unbiased in the prices, but you can...
But what does that mean when you say unbiased? What does that mean?
So if you take the whole probability distribution into account on the pricing of oil, but not take a stance on the positioning, but you take what the market is telling you in terms of probability.
The only thing the market is telling you is the price. Right? So in a sense, the probability is something you might decide to build around the price. The market is just, it delivers a number. It's the price today is. You're valuing the company as of today. It's, first let's say, that price is what it is. You can think it's high or low, but it is what it is. Yep.
I think you could do it without taking a strong stance, largely because they continue to operate a lot of their assets regardless of the price of oil, just to pay off stuff like that.
There is no way an oil company can escape the oil price. Today I'm going to show you Royal Dutch, and you're going to see how completely tied the company is to oil prices. You can try, it's almost impossible to do. Yep.
I remember you did a simulation previously for valuation, so could you apply that here and say, take the historical...
You're one step ahead of me. That's exactly what I'm going to do, because when I value oil companies, is it true the oil company's value is a function of the oil price? Absolutely. Is it also true that forecasting oil prices has become impossible to do? I think so. So here's what I'm going to try to have my cake and eat it too. I'm going to value the company at today's oil price, and then I'm going to look at oil prices as a distribution, because I'm not saying oil prices will not change. In fact, I'm just saying I don't know which direction and how much. A distribution is a perfect way to bring it, so we can have our cake and eat it too. It's a great way to value commodity companies because I'm going to argue about the dangers of putting a commodity price view into a commodity company. Is your commodity price views then going to drive what you think about the company? You see what I mean? If you think oil prices are going to double over the next 5 years, what are you going to find at the end of your valuation? Royal Dutch looks cheap to you. So we're going to talk about the dangers of commodity price views and how to get around them. So let's say you value Amazon today. This must have been an old valuation. And you come up with $515 per share. Let's say the stock is trading. Let's update the numbers. Let's say you value Amazon today. I think it's trading at around $1,600 today. $1,700. Let's say you value it at $1,400. and it's trading at 1700. Which of the following statements most likely explains the difference? The first is the market is much less optimistic about the company's fundamentals than you are. Is it more optimistic? The price is higher than your value, so market must be more optimistic. Or maybe the market is not even looking at fundamentals, right? If you're an intrinsic value person, you're trying to explain away the difference with fundamentals, but a pricing game. It could be that they are just pricing the stock. I mean, take a look at what's happened to Lyft since the IPO, right? Do you think fundamentals are driving it? I think it has nothing to do with fundamentals. That's one of the reasons we're going to focus on pricing, is we want to get a sense of how the pricing game is played. Not because we want to play it, or I want to play it, but if I'm an investor, I need to understand the pricing game, because that's how I ultimately will make money. So one reason I'm going to introduce the game is for us to understand. So final point, and this is something we've kept talking about. You come up with a company that's undervalued, and so if you're going to act on that valuation, which of the following do you need? Faith in your estimate of value, faith that the stock price will move towards value, faith that you can hold till that happens, or none of the above, all of the above. What do you think? Yeah, good.
C.
You think just C, faith that you can hold on? But if you have no faith in your value and faith in the price will adjust to the value, just the third one is not going to get you there, right? Do you see how you need to have faith in all three? Now you see why most people can talk the investing game, but playing it is a very different proposition. Okay? So we're going to talk about it, but in a sense, you can get the mechanics. By the end of this class, you might know how to value a company. The mechanics are easy, and you can get better at it by valuing more companies. The faith part takes work. It takes experience, it takes pain, it takes getting tested, it takes coming back. And for some of you, you might decide this isn't working, and that's okay. Yeah? But that's something that's an ongoing process. It doesn't end at the end of this class. It's every time you invest, you're getting some measure of whether that faith is merited and whether you should hold on to it. So when we think about pricing, that's something worth thinking about. So let's go back and finish up the last stretches of intrinsic valuation. I've been told that the bookstore does not have the second packet. Is this true? You haven't even looked, have you? God. Or at least you're taking the cheap route. If you're cheap, do so. I hate the bookstore. I don't want them to make any money off me. So don't buy it at the bookstore. Right? But if you like that professional binding that they put, or whatever they add, I'll work on getting sure the book. But when I left you with emerging market companies, right? And we're talking about all the issues with emerging market companies. Dealing with country risk, I said use a scalpel, put it into your discount rate. Then we talked about corporate governance and how that can play out. I want to talk about cross-holdings. Again, it's not an issue restricted to emerging market companies, but it's a bigger issue with emerging market companies, partly because you have so many family groups in emerging markets which have a long history. Anytime you have a family group, you're going to have cross-holdings. So we talked about all the perils of cross-holdings at companies and how they can add this layer to value that is opaque, that you have to take on trust. So I'm going to show you an example of how cross-holding, can you all read every number in these pages? Don't even try. Okay? I'll set up the process. This was about 10 years ago. I was asked by the Tata group to come in and talk about the valuation. They said, pick any 4 companies, take us through the process. And I picked 4 companies, Tata Steel, Tata Chemicals, Tata Motors, and Tata Consulting Services, all part of the Tata group. And I did a discounted cash flow valuation. And each of them, there's a story, cash flows. Tata Motors, Tata Steel, Tata Chemicals were fairly mature companies and mature businesses. Tata Consulting Services was an outsourcing company with a little more growth. And then at the end of the valuation, remember after you've discounted the cash flows, the cost of capital, I added the cross-holding. So this is all about the cross-holding. So I'm going to focus on the cross-holding part. See the blue part, that is actually the present value of the free cash flows at the cost of capital. The red part is the value of the cross-holdings at each of these companies. So if you take a look at Tata Chemicals, about half the value comes from the discounted cash flow valuation, half comes from the cross-holdings. Tata Steel, pretty close to the same. Tata Motors, 60% comes from the DCF, but a big chunk in those 3 companies comes from the cross-holdings. But then look at Tata Consulting Services. Only about 5% comes from cross-holdings. Why is that? What is it about? I mean, they're all Tata companies. Why are there fewer cross-holdings at Tata Consulting Services than at Tata Motors, Tata Steel, and Tata Chemicals?
Probably to have an equity method investment so that we can control their suppliers.
Yeah, if cross-holdings were the result of actual operate, you're right. If you were deciding, should I cross-hold, those things might come in. But remember, cross-holdings reflect history. Tata Motors did not set out to have cross-holdings in other companies. Tata Steel didn't want it. You know how it happened? 50 years ago, when Tata Chemicals needed a factory, Tata Steel was having a good year. The Tata family took, because they owned both companies then, they were private companies, they would take money out of Tata Steel and put them into Tata Chemicals. And the accounting was they would give them shares, which basically meant nothing because they owned all of the companies anyway. With the accounting, they put the shares in. So these cross-holdings have built up over time, a reflection of their history when these companies were privately owned and internally capitalized. I think I've given away the answer. So why does Tata Consulting Services so much less? They're the youngest of the companies. They're the company that's been around only 20-something years, and they've been around when the Tata Group has been public. So it's not as if Tata Consulting Services has done the right thing and the others haven't. It's just a reflection of their very different histories. In fact, I valued Tata Motors for the group, and I came up with a value that was slightly lower than the stock price, which was good because I didn't want to buy the stock anyway. So I said, thank you, I'm not buying the stock. And the CFO of Tata Motors was in the front row. He said, he posed a hypothetical, and I hate hypotheticals. He said, 6 months ago, our stock was 35% lower. It would be much lower than your value. Would you have bought our shares then? And I had to tell him the truth. I said, I will never buy a Tata company. He said, what? We're a good family group. We have all these good companies. I said, buying a Tata company is like getting married. And the day after you get married, your entire set of in-laws move in the bedroom with you. I get along fine with my in-laws, but I don't want them all in my bedroom. Do you see what the analogy here is? I want to buy, if I like Tata Motors and I want to buy Tata Motors, what do they make me do? Take all the in-laws with them. And there are a lot of them. See all that red line? That's the in-laws coming with the company. Getting a clean play on these companies is really difficult because of the cross-holding culture. So you got to deal with it. We'll do the best you can. We talked about all the different issues with cross-holdings. Final lesson. Again, this is not just for emerging market companies, but emerging markets are particularly susceptible to this. There's a great deal more truncation risk at the companies. What's truncation risk? Risk that can cause the company to stop existing. I remember doing a 2-day valuation, or actually a 1-day valuation seminar in Antigua. Saying, why did you go to Antigua? It was a very cold winter in New York. And I got a call from somebody in Antigua saying, can you come to Antigua and do a valuation seminar? And I said, where's Antigua? He said, it's in the Caribbean. It was like minus 20 degrees outside. I said, I'll be there tomorrow. So I showed up in Antigua, do a valuation seminar. We're talking about risk and return. There were about 80 Antiguan business people in the room. There's no investment community or market. So mostly people running businesses. And I said, what's the biggest risk you face? Expecting things like exchange rate risk and country risk. You know the most common risk they cited was? A hurricane. Because 60 of the 80 people own businesses related to tourism. This is a tourist island. For them, a hurricane was catastrophe. So I asked them, why don't you buy insurance? They said, do you know what the cost of insurance would be? We'd go out of business. So they lived hurricane to hurricane to hurricane. The point I make is we take for granted in markets like the US, I didn't think about natural disasters, how big an issue can be. I can insure against natural disasters. There are parts of the world where natural disasters are front and center, and there's nothing, if you're a small business especially, that you can do about it. That's truncation risk. Terrorism risk. Now, unfortunately, in much of the world, this has become an issue. I was valuing an Egyptian hotel a few years ago. And if you've been reading the news, there are all these incidents at especially luxury hotels all over the Middle East. In fact, in Mumbai, in the Taj, 10 years ago, you had a bunch of people break in, shoot people. So it can happen. Terrorism risk. Again, that Egyptian hotel, there was another Egyptian hotel that shut down after a terrorist incident. And finally, Any of you valuing a Venezuelan company? I thought not. And there's a reason, right? If you value a Venezuelan company, truncation risk is front and center. You might not make it through next week, next month, next year. And let's face it, truncation risk is the worst risk to face in valuation because it's so difficult to bring into your valuation. So now let's talk about valuing banks. I wrote my first valuation book in 1988. I feel really old because, but last 2 weeks ago, I was at Disneyland with my grandson, and he's 1 year old. So he's got my son works at Disney, so he goes to Disney World, Disney. So this is his 5th visit, but we're on there's this Tower of Terror, which has now been renamed. So you get into these lifts, and they put you into a thing and they shoot you up and down. We get in and this person sits next to me and she says, "Can I take a picture with you?" I said, "You're in Disneyland, you want a picture with Mickey, not with me." She says, "When I was a kid, I used to read your books." This is like a grown-up person. And I'm saying, oh my God, I need to get a different occupation here, But my first book was written in 88, and between 88 and 2007, I wrote multiple editions of multiple books. And there's always a chapter in valuing banks in every one of these books. And every one of these chapters started with a sentence that I've never been able to live down. Every chapter I wrote in Valuing Banks said, valuing banks is easy. And then the rest of the chapter would flow. And here's why it was easy. It is built on 2 presumptions about banks. The first is that banks were run by sensible people. And the second was banks were regulated by regulatory authorities who kept them from doing something stupid. Because when you think about valuing banks, here's the concern you face. Remember those 4 questions? You have a bank. I'm going to ask you the 4 questions. You're going to see very quickly why people very quickly gave up on traditional valuation. I ask you, what are your cash flows from your existing assets? How do we measure cash flows? We start with earnings. We add depreciation. We subtract capex. We subtract change in working capital, right? Try doing that for a bank. You will rip your hair out. Because what's capex for a bank? What's working capital for a bank? There's no such thing as depreciation. But you can't say earnings are cash flows either. Clearly there's reinvestment. You just don't have any conventional measure. So for a long time, people just threw up their hands and said, you can't estimate cash flows for banks. And this is where the trust came in. We said we cannot estimate cash flows for banks, but we can see what they pay out as cash flows, which are dividends. And if banks are run by sensible people, what will they pay out? What they can afford to. So we're going to take the dividends and we're going to discount back at a cost of equity. And to get a cost of equity for traditional companies, what do? We start with the risk-free rate, then we look up the betas for the businesses you're in, we'll unlever and relever. And initially I tried that for banks and very quickly gave up. Why? To unlever and relever, what do I need? A debt-to-equity ratio. Try estimating a debt-to-equity ratio for a bank. In a sense, everything is debt and nothing is debt. And if you think about it, debt is not a source of capital to a bank, it's raw material, right? You borrow money at 4, you lend it at 5. If I call that debt, I'm going to have a 99% debt ratio. So with banks, here's what we used to do. We didn't unlever or relever banks. We took the average beta across banks. Every bank had the same cost of equity. And you know why we got away with it? Because we assumed the regulatory overlay worked. So you didn't have any risky banks because the regulators would not allow that to happen. So until 2008, to cut a long story short, the way I valued banks is with the dividend discount model. So if you ask me to value bank, and if I brought that dividend discount model to today, here's how the valuation of a bank would look like. It's a bank called CIB Egypt. Obviously, it's an Egyptian bank. I'm doing my valuation in Egyptian pounds. The old-fashioned dividend discount model, what do I need? I need expected dividends for the future. So I start with the dividends in the most recent year. They paid one pound in dividends on a 4.04 earnings number. And I did an internally consistent dividend discount model. What does that mean? I computed growth based on retention ratios and return on equity. And as my growth rate decreased, I adjusted my payout ratio up. So I got expected dividends in the future. It's actually much more comforting DCF because the numbers are all in front of you. You're not doing things like what's my capex, what's my working capital. You just take the dividends, you project them out. You discount those dividends back at the cost of equity. And because I did everything in Egyptian pounds, I needed an Egyptian pound cost of equity. And this was tricky because there was no Egyptian government bond in pounds. It didn't stop me though, because here's what I did. I took my US dollar risk-free rate at that time, which was 2.27%. And remember how you can adjust a discount rate from one currency to another? You take the difference in inflation. I took the difference in inflation and came out with the Egyptian pound risk-free rate. I'm doing the dance, but I'm doing a dividend dance. I project dividends, I discount them back at the cost of equity. What I get as my present value is 42 pounds. Stock was trading at 36 pounds. I tried to actually buy it. It's very difficult to actually do a transaction with an Egyptian stock. It's not like going on Charles Schwab saying, look up CIB, buy 1,000 shares for me. Okay? I actually was not able to actually complete the transaction. There are all kinds of restrictions on who can buy Egyptian shares and what currency. And maybe I shouldn't, because when I use the dividend discount model, what am I trusting? That this bank is run by a sensible person, which I don't know, and that the Egyptian banking regulations actually work, which I absolutely have no idea about. Anytime you use a dividend discount model to value bank, implicit in that usage is the assumption that the people running the bank are paying out what they can afford to, and that if there are risks in the bank, the regulatory guys put a lid on it. So I know most of you haven't heard of CIB Egypt, but this, I'm sure most of you have heard of the next bank I'm going to value. This is Goldman Sachs, August of 2008. This is the start of a sad story. And you'll hear the sad part of the story towards the end. So I sat down to value Goldman. It was a high growth bank in August of 2008. High growth in what sense? It paid low dividends, had a huge return equity. So if you look at the numbers, for the first few years, I'm keeping the payout ratio at less than 10%, because that's what they're doing right now. The return on equity was sky high, 13%. You take the product of those two numbers, I get a growth rate of 12%, so I project that out. Now, if I leave the payout ratio at 9% and bring down the growth rate, I'm going to kill the value. So basically, as the growth rate, if this is triggering memories of problem 1 and quiz 2, let it go. As I bring the growth rate down, I bring the payout ratio up, which effectively means as you go through time that the dividends are going to start growing a lot faster than earnings per share, because my payout ratio is increasing as my growth rate decreases. Again, like CIB Egypt, I'm focusing on dividends, and I'm discounting back at a cost of equity, because dividends are a cash flowed equity. The value per share that I get by discounting dividends back at the cost of equity is 222. What's the stock trading at?
198.
It was 169. So ask me the question. I bought. And that's the start of a sad story. Because this was August of 2008. Guess what happened the next month? The crisis happened. By December, you know what the stock was trading at? $72. Did I beat myself up? I said, it's not my fault. There's a crisis in the middle. I didn't see the you should have seen the if I'd seen the crisis coming, I'd have done a lot of things, like gone and hidden in the hills or done something else, but I didn't see the crisis coming. That's intrinsic valuation in a nutshell. You can be right on your intrinsic value, but if in fact there's something that hits the entire market, don't sit there saying, I did my intrinsic value, I'm going to be rewarded, because the market's down 40%. Your stock is going to be down as well. So it is again to remind us, so even if you believe your dividend discount model value. In fact, if Goldman had paid no dividends, could I have used the dividend discount model to still value it? It's actually a nice interview question. Can you value a non-dividend paying stock with a dividend discount model? I think you can. How would you do it? Well, you put a zero dividend. What's going to happen for the first 5 years? Your retention ratio is going to be 100%. Your return equity is going to be whatever it is, so you're going to have higher growth. After year 5, as you bring the growth rate down, you will make them pay dividends, because the payout ratio will climb. So keep that question, because now that do you all have your jobs already? Or if you have a job, keep this as a question, because you'll start to get more and more sadistic as you stay more. And then when you come back, you want to punish other people by asking them questions that you don't think. This is a good question to file away. Okay? Can you value a non-dividend paid? It sounds like a trick question. So what does he want me to say? You can value a non-dividend paying stock with a dividend discount model if you adjust the payout ratios, the growth decreases. So that was until 2008. Trust in banks being run by sensible people in trust and regulatory. Those days are long since gone. Here's what 2008 taught me, that banks are run by some of the least sensible people on the face of the earth, and that the regulatory overlay obviously doesn't work. That trust is gone. In 2009, I was lost. I was lost because my old way of valuing banks was gone. I didn't trust dividends anymore, but I hadn't quite figured out what to do next. So I'm going to set up the process of how I approach valuing banks now. Let's start with some obvious statements. First, banks are incredibly opaque entities. You know what I mean by opaque entities? You can read an annual report for a bank, but there's actually very little you learn about banks by reading their annual reports, because it's not their fault. It's just very difficult for banks to tell you how risky their loan portfolios are. They can't exactly say, and if you take an Indian bank, you could be looking at it and they're not telling you what their bad loans are, so there's lots of stuff you don't learn. And for a long time, we made a Faustian bargain. We've always known banks were opaque. For a long time, though, the Faustian bargain was banks didn't tell us very much, but we were okay with it because the regulatory authorities supposedly had the information. They were making sure that the banks were not stepping out of bounds. Okay? So if you took Wells Fargo, for instance, in August of 2008, you asked me to evaluate, I'd use the dividend discount model, and I said, okay, the regulatory authorities are going to make sure Wells Fargo is not going to do something wrong. In October of 2008, 3 weeks into the crisis, so I'm in prime crisis mode now. The only tool I have is still the dividend discount model. I decided to value Wells Fargo. I valued it because the stock had dropped from $60 down to $33. And when a stock drops that much, your first instinct must be, it must be cheap. It's dropped so much. So I decided to take a look at Wells Fargo, still with the dividend discount model. I hadn't replaced it yet. And within the dividend discount model, here are the two numbers I moved, because Wells Fargo had actually revealed no new financials since the crisis. Remember, the crisis started September 12th. I was still stuck with the old numbers. I said, where in my numbers can I reflect the fact that the last 3 weeks have happened? First, I adjusted my cost of my equity risk premium, which used to be closer to 4%. I pushed it up to the implied premium when I did this. Higher risk premium, higher cost of equity. First adjustment. The second adjustment I made was we knew 3 weeks into that crisis that this was a banking crisis. And we also could see what was coming down the road, which was that the regulatory authorities were probably going to raise regulatory capital requirements for banks because bank after bank was running into capital problems. I don't know by how much, but the second adjustment I made was I assumed that over time that the regulatory capital requirements for banks would go up by 30%. So how is it affecting your valuation? Remember, I don't have any updated income numbers, but if your book capital has increased by 30%, your return in equity is going to drop from whatever it was, even if you continue to have the same earnings power, to a much lower number. You put in a lower return equity, you get a much lower growth rate. So I have a higher cost of equity, a lower return equity. The value per share that I got was $30.29. The stock had dropped, but the value had dropped even more. And that's within the dividend discount model. But I still was extremely uncomfortable because I was still using dividends and I was still trusting Wells Fargo to be run by sensible people. So now I'm going to set up how I had to think through valuing banks. I'd like to get a free cash flow equity. That's the reality. I'd like to estimate free cash flow equity for banks. The reason I'm stuck is I don't know what capex and depreciation and working capital are. So I had to think about what would I call reinvestment at a bank. What does a bank have to do to survive and grow? And here's what I latched onto. Banks are regulated, and for them book value actually matters. Banks are one of the few sectors where book value matters because the book value of equity becomes a key ingredient of regulatory capital. So you got the Basel Accords and regulatory capital requirements. Book equity becomes a key part of regulatory capital. So here's my rationale. If you're a growing bank, you've got to come up with more regulatory capital to grow. So in a sense, you've got to invest in regulatory capital. If you're an undercapitalized bank, to survive, what do you have to do? You have to bring your capital ratio back to whatever the regulatory authority did. So I'm going to argue that for a bank, what you have to put into regulatory capital to survive and grow is like capex. Because if you refuse to do it, what's going to happen? If you're undercapitalized, you will be shut down, and if you're growing, you're going to run into a problem sooner or later. So I'm going to start with the net income, and I'm going to subtract out what you have to invest in regulatory capital, and I'm going to come up with a potential dividend for a bank. Let me ask you a question. Is it possible that what I invest in regulatory capital, what I need to, is higher than my net income. Sure, if I'm a really undercapitalized bank or I'm a really high growth bank, I'm no longer constrained to say you're stuck at zero. If you're a really high growth bank or an undercapitalized bank, I could end up with a negative. You're saying, so what? What is a negative free cash flow to equity? Tell me as an equity investor. They will have to issue new shares, which will... So in a sense, I'm now free to bring in these banks that used to be off the table and say, hey, you know what? You're a basket case bank, but I can tell you what your value of equity is based on what your free cash. So let's pick a basket case bank. I'm going to use Deutsche. Anytime you want a basket case bank, Deutsche is a good target. Why? Because a company does not seem to know how to get out of its own way. I mean, Deutsche's history is great. It's one of the great, most solid institutions of all time. In fact, in 2016, when I valued Deutsche, and I'm going to show you the value, my blog post was titled, A Greek Tragedy at a German Bank. And I wanted to bring the word Greek so much into the discussion. You know why? Because Germans like to beat up on the Greeks. They say those Greeks, they don't know how to manage businesses, they're terrible. And here you have the ultimate German institution, Deutsche Bank, looking like a Greek bank. I said, this is great. This is like Schadenfreude or whatever they say. You know, it comes, what goes around comes around. It's come around. So I decided to value Deutsche in October of 2016, and Deutsche was in serious trouble. Let's see why. Starting in 2008, year after year, Deutsche had been losing billions of dollars. Now, when you lose billions, what happens? Your book equity drops. Now, for a normal company, that's bad, but it's not the end of the world. But for a bank, when your book equity drops, your regulatory capital is dropping. So the regulatory capital had been dropping for almost 8 years. And in 2016, they got they essentially got the cut that drove them over the edge. The US government imposed a $15 billion fine on Deutsche for their role in the 2008 crisis. Remember, $15 billion coming out of book equity, now you're really in trouble. People were freaking out. The CDS for Deutsche shot through the roof. There was talk about the German government essentially taking the bank. Because remember, Deutsche Bank is not going to go bankrupt. It can't be shut down. You can't shut down a bank where people, so it will essentially be government controlled and then perhaps come back out. But if that happens, your equity is going to be worth nothing. So there was talk about the German government stepping in. So I said, I'd like to value Deutsche Bank. Initially, I tried the dividend discount model. And I very quickly realized the dividend discount model would get me nowhere because this was a non-dividend paying bank. You're saying, but we said that non-dividend paying banks can be valued. That's a non-dividend paying bank with good potential, where you hope it will grow out. This is a non-dividend paying bank for a different reason. It's so severely undercapitalized that you might never see a dividend again. So I decided to do this the hard way. I first started with the net income, and the net income when I started, this was a loss. They were losing $8.85 billion in the trailing 12 months coming into my valuation. That's not going to be fixed overnight. They have serious operating problems. So over time, I gradually improved their return on equity, saying, look, you can't let one of the largest banks in Europe essentially go bankrupt. It's going to, over time, it's still got some significant advantages because it has all these branches. It's got loan networks that's huge. Over time, I expect its return equity to go from negative to positive. And eventually, you know what my happy scenario is? They'll eventually earn their cost of equity. I'm not asking for miracles here. In my world, that's what's going to happen is if they recover, by year 10, they will earn their cost of equity. The return equity will converge at 9.44%. As your negative return equity becomes positive return equity, your net income goes from negative to positive. Half my problem. It's like doing Amazon, but in a much more depressing scenario. Negative income becomes positive income. Then I turn my attention to reinvestment. And remember what I said about reinvestment for a bank. It's going to be investment in regulatory capital, right? So to estimate my investment regulatory capital each year, I had to make two assumptions. First was about growth. Because remember, you have high growth, you need more regulatory capital. That's not an issue with Deutsche. It's not a high growth bank, so I didn't expect much growth. But they have a second problem. Their existing Tier 1 capital ratio, which is one of the most basic regulatory capital ratios, incidentally, on S&P Capital IQ, you can pull these numbers for banks, was 12.41%. I was able to pull this for all banks globally. And I computed a histogram of Tier 1 capital ratios. You know why? Because I'm not a banker. If you ask me what's a good tier 1 capital ratio, I can give you the regulatory minimum. I have no idea. So I said, let me look at the numbers, because why make up a number if you don't have any idea? And it turned out that the 75th percentile for tier 1 capital ratios for banks is about 15.67%. I moved Deutsche towards the 75th percentile. You're saying, why are you pushing it towards the 75th percentile? Many banks globally are just banks. Any bank with an investment banking arm has much more risk, and if you have much more risk, your tier 1 capital ratio has to be higher. So I'm saying, given the mix of businesses at Deutsche, being a big bank is not going to help them. They still need a high. So over time, I'm trying to push that tier 1 capital ratio from 12.41 to 15.67%. I know it sounds torturous, but hang in there. As my tier 1 capital ratio goes up, I computed how much tier 1 capital I will need each year. And as my tier 1 capital changes, that change from year 1, for instance, from the current number to year 1 is minus 6.55. I'm assuming that Deutsche has to come up with that extra amount to get to that ratio. So let's take year 1. I expect them to continue to lose money, $5 billion. On top of that, they've got to come up with $6.6 billion in regulatory capital. Their free cash flow to equity in year 1 is minus 11.7 billion. I go to year 2, I go through the same process. In fact, for the first 3 years, for the first 4 years actually, but the first 3 years in big amounts, I'm getting negative, 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 negative. I'm telling you a story, right, with numbers. What's the story I'm telling about Deutsche? That it's going to dig itself out of the hole, and it's going to become a bank that earns its cost of equity, but along the way it is going to have to issue a lot of new equity because it has to do it to survive. Eventually it turns a corner, partly because its net income finally starts to become positive, and partly because its tier 1 capital ratio catches up. I actually assume that the bulk of the catching up happens early, because it's very dangerous for a bank to be undercapitalized, that they will try to catch up early. So the negative cash flows are up front. See that free cash flow to equity? That is my potential dividend, and for the first 4 years, it's negative. So like any other company, negative free cash flow to equity, I'm incorporating that into my value. When I take the present value of my cash flows, all of those free cash flows to equity at the cost of equity, the present value that I get is 31.8 billion. And that is assuming what? That Deutsche manages to dig itself out of the hole and fixes its regulatory capital, becomes an average risk bank. Lots of ifs in there. So because there are lots of ifs, I did discount the cash flows at a cost of equity reflecting a risky bank. And this was tricky because I really didn't know how to do this when I first started, because everything I know about adjusting the cost of equity is to take the beta, unlever it and relever it. But here I actually have to come up with a beta for risky, average and safe banks. And I actually did it by taking my individual banks, breaking them into 4 quartiles and computing the cost of equity. Remember how we did the implied cost of equity for the S&P 500? I did that for groups of banks and ended up with a histogram that told me if you're a risky bank, what's your implied cost of equity? If you're an average bank, and for a risky bank, the implied cost of equity is about 9.44%. That became the end number, but to start the game, I actually gave them a much higher cost. I'm sorry, the 10.2% was a high cost of equity. And over time, I pushed them towards an average cost of equity for a bank as they improved the regulation. So to me, when you ask me what should the cost of equity for a bank be, I'm going to ask you a question about, is it undercapitalized, is it correctly capitalized? Because to me, that's the driver of risk in a bank. If you're undercapitalized, you're automatically a riskier bank. I'm going to give you a higher cost of equity. I get a value of equity. Now, is there a chance still that Deutsche might not make it, at least as an equity investor? Yes, you have one big shock, and it might very well be that the German, as I said, it doesn't mean Deutsche will go away, but it will become a government-owned bank. And if that happens, what's my equity going to be worth? It's going to be worth nothing. So I brought in a likelihood, and I put in only a 10% likelihood. You know why it's so low? Because it's too big to fail. And I'm not being facetious. If this had been a smaller bank, I'd have put a 40 or a 50%. But if you think about a bank like Deutsche, the German government does not want to make it a government-owned bank. The other financial institutions don't want that to happen either, because so my guess is if Deutsche really needs capital, that you're going to get a lot of help. It's going to be like Bear Stearns on steroids. If those of you remember, Bear Stearns before Lehman had got in trouble, the other banks all got together, came up with enough capital to keep it going. So that's why the probability is so low, is because it's so large. The expected value I got was $20.67. The stock was trading at $13.33. Come on, by now you know what to ask. Did I buy? I did, and I initially got really lucky because it turned out, remember the capital they had to raise? They used rights issues. You know what a rights issue is? Every stockholder is given the right to buy an additional share. And if you don't want to exercise the right, you can sell the rights for cash. So when they made the rights issue, I actually cashed out on a lot of my shares. And this is about 9 months. I really wanted to hold on because I wanted to hold on for a year because your tax rate goes down. But I looked at the number and they were offering 23, I think, on the rights issue. And they said, I'll take it. That's a good enough payoff. And thank God I did. Because it went through this crisis, it lived through it, but then it figured out a new crisis to create for itself. With the CEO, we don't know who the CEO was. The CEO yesterday is not the CEO today. So now they're going through a different crisis, which means if you want to value a bank in crisis, you can always call on Deutsche because it's in a new crisis. So if you want to try what I did in 2006, you can actually download the spreadsheet. Take Deutsche today and play with the numbers. It's a great way to start to see what drives the value for a bank. This morning when I was the earlier class, when I was doing with the MBAs, somebody in the class asked, but there's going to be dilution, right? Is there going to be dilution? Yeah, absolutely. And you know the next question you asked me, right? Which is, if there's going to be dilution, how come you're not adjusting the number of shares outstanding for the dilution? Why shouldn't I? Tell me how, because you're going to have exactly this question asked of you when you go to work and you have a company with negative cash flows. Tell me how you're right that it's been built in. How is it built in?
When the FCFE is negative, that means that you would have to raise equity in order to...
No, but tell me where in my value did I build it in? How did it show up? Is there a way, for instance, if you're having a tough time convincing somebody, I want you to tell me a way in which you can show them how much dilution you've already built in. There's actually an easy way. I want you to think about it. See those first 4 years of cash flows? Set them to 0, compute the present value. You will get about 40 or 41 billion. So basically, if I take out the negative cash flows, the value I actually got was 31.8 billion. I've actually reduced my value by 25%. Why? Because I have negative cash flows. Now, if I take those shares I issue to cover those negative cash flows and add them to my shares outstanding today, I'm actually double counting, right? Because I'm lowering the value by about 25% and pushing up the number of shares by about 25%. But you know how often I see that done in DCF? It's terrifying. People adjust the number of shares for and the logic sounds good when they're doing it, and what they're missing is if you've done your DCF right, your present value should already reflect those negative cash flows. It's actually a very convenient way of adjusting dilution, because try doing it the other way. To figure out how many shares I will have to issue in years 1, 2, 3, and 4, what do I need? I need to make an assumption about the price. This is like a circular problem, because to get the value today, then I have to estimate a price I don't even want to go there. I'm going to let the cash flows carry the burden of dilution. It's already in there. You can move on. Yes?
So if you just try to find the present value of all the losses?
Yeah, just say, because remember, the reason you issue shares in a DCF model is not because you like to issue shares, it's because you need to cover negative cash flows. And the years there are positive cash flows, I'm not issuing shares. So the essence of a DCF is share issuance happens because you have a negative cash flow. You're going to cover it. So if you want to show the effect of dilution, just take out the negative cash flows, compute the value without them. You can then show people this is, in fact, if you look at the blog post that contains Deutsche, I do exactly that, because I knew that people are going to push back saying, how come you're not adjusting the share count? Because they were talking about dilution in all the news stories. And I said, this is why. A DCF done right should already have dilution in it. Okay? And those of you who are valuing young companies in this class, this is a way in which you can, because if you look at it, maybe you didn't even see it happening in the spreadsheet, you have long negative cash flows. You're valuing Salesforce, you're valuing, I don't know, whatever the young company is, Pinterest. Okay? You have negative cash flows. You have dilution, and the reason you haven't adjusted the number of shares, it's already embedded in your DCF. Now let's talk about valuing commodity companies. So you're a commodity company. Let's make you a mature commodity company, an ExxonMobil. When I ask you what your cash flows from existing assets, show me last year's financials. Will they look good or bad? Depends on what the oil price was last year, right? If it was 100, the numbers are going to look much better than if they're 40. When I ask you what's the value of growth, it depends on the oil price. The oil price is 100, everything you're doing looks great. The oil price drops to 40, nothing you do looks great. When I ask you how risky are you, when oil prices are high, your debt ratio is low because you have high earnings, high market cap. But if oil prices drop, all of a sudden you're a risky oil company. When I ask you when will you be a mature company, when oil prices were high, you thought about growing for the rest of eternity. Now I'm looking at low oil prices, you're saying I'm already a mature company. You see how the answer is driven by the price of oil to every single question? So when you think about oil companies, the first, let me do the oil companies first and then I'll come back. Every question, so don't worry, I'm not skipping the pharmaceutical companies, I'll come back to them. Every single question I ask will be driven by what the oil price is. So I'm going to take that first statement and kind of be open about it. It is absolutely true that the value of an oil company is driven by oil prices. But it's also absolutely true that if you take your oil price view into that valuation, you created a very dangerous setting. But when you tell me a stock is cheap or expensive, I don't know whether the company is good or whether it's because you think oil prices will double over the next. And that's dangerous because if it's a ladder, if it's because oil prices are going to double, there's a far simpler way for me to make money, which is to buy oil futures. So one of the first rules in commodity company valuation is you want to be commodity price neutral. And I'll be honest, I did not realize how difficult it is to make your commodity company commodity price neutral until I actually started valuing commodity companies. This is why valuation is a craft. In the abstract, say, what's the big deal? I just take the current price and I build it in. You're going to see in the valuation why it's going to take work. So the company I'm going to use to illustrate this process is Royal Dutch. And along the way you feel the urge to guess, but we're going to use simulations to kind of deal with that uncertainty about the oil price, the probabilistic tools. So let me start with the graph that's going to show you how much oil prices matter at Royal Dutch. This is the graph that, where's the graph? Yeah. It's a graph where I took Shell's revenues every year from 1989 through 2015. And I put the oil price on the same graph. Do you think the two move together? I didn't trust the graph, so I said, let's look at the statistics. I did an R squared. The R squared is 96.4%. Ask me who the CEO of Royal Dutch is. Who's the CEO? Thank you for asking. I don't know, and I don't care. What's he going to do? Come watch the terminal a little more carefully to see what the oil price does? This is an oil price play. When I'm investing in Royal Dutch, I'm not doing management assessments about the quality of management because there's nothing. They're at the mercy of oil prices. So I wanted to look at this graph because I did something else over this period. I ran a regression of revenues at Royal Dutch against the average oil price. Hold on to that because it's going to become very useful when I value Royal Dutch. So here's my Royal Dutch valuation in March of, I'm sorry for going back and forth, March of 2016. So let me set up where we were in March of 2016. The oil price was at $40 a barrel. So I pulled up the trailing 12 months for Royal Dutch because I want a base year. And it turned out that in that 12-month period, the average oil price was $55 a barrel. You see already what my problem is going to be? If I take my trailing 12-month numbers and make that my base year numbers, what am I going to end up doing to Royal Dutch? I'm going to push up my value. Why? Because I'm estimating a 55 when the oil price is 40. So I need to figure out what Royal Dutch's revenues and earnings would have been if the oil price had been 40, right? And this is where this graph helped me. See that regression there? That tells me what the revenues will be as a function of the oil price. I went in and plugged in a $40 oil price into that regression. I got a predicted revenue of $201 billion. It looks like I'm playing a dangerous game, but I actually took the existing revenues, which is $210 billion, and replaced them with the lower revenues. Why am I doing that? The $210 billion reflects a $55 oil price, And because the oil price has dropped, I've got to reduce my revenues. That became my base year revenues. I learned this lesson the hard way. I think it was about 6 years ago that I bought Vale. You know Vale, Brazilian mining company. I bought it after iron ore prices had collapsed. Brazil was in a tailspin. The real was going all over the place. I called it my 3C bet. Commodity, currency, and country are all kind of gone into a tailspin. And I bought Vale based on a valuation. And I based the valuation on the trailing 12-month numbers, which I assumed already reflected the low iron ore price. So I built that. I valued the company about $13. Stock was trading at $9.90. I buy it, and the stock goes to $5. Wrong direction, in case you're wondering. So it's 2 years later. I'm looking at a stock where I've lost half my money, and I said, what did I miss in my original valuation? I'm not doing this to beat myself up. I just want to make sure whatever I've missed, I don't continue to miss. So I went back and looked at the numbers, and it turns out that at least with mining companies, it takes about 2 years from the time the commodity price drops to actually the numbers actually showing up in your revenues and earnings. You know why? A lot of futures that they lock in, prices. So basically the low iron ore price in 2013 didn't actually fully transmit into Vale's numbers until 2015. So when I was using the 2013 numbers, guess what I was reflecting in my valuation? 2011 iron ore prices, which were much higher. And there goes my valuation. That was about a half of my value right there. But I said never again. When I value a commodity company from this time on, I'm never taking the trailing 12-month and just taking it as given. At the minimum, I'm going to check the average oil, average iron ore, average gold price during that period to the price today. If it's pretty close, then I'm okay with it. But if it's different, I've got to figure out a way to adjust for it, because otherwise I've built into my valuation a pricing for the commodity that doesn't reflect it. Once I did it, the rest of the process cleaned itself up, because once you normalize revenues, your earnings get normalized. There's no big high growth period here. I'm effectively assuming that existing prices are in fact the only price I know. I build the valuation around it. It doesn't mean that my prices can't change. My price, I can use the futures market but remember, the futures market doesn't give you an expected oil price. Why not? With a storable commodity, there is absolutely no information about futures prices, future expected prices in your futures price. Why? Because otherwise you can have arbitrage. The futures price for a commodity is always going to be the spot price adjusted for the storage cost and interest rates, because you can borrow the money, buy the oil, put it in a store, and get it out 1 year from now. That's why you don't learn anything by looking at futures prices. It's different when you're looking at futures prices for wheat, because there it's actually not, you can't store it for a long time. There you might get some information, but the oil, what you're getting in the futures price is really the spot price, 1.3% higher every year for the next 10 years. You can use that because it's still a market price. That became the basis. The value that I got was about $39. So I finished the valuation and I presented to a group of oil analysts somewhere. And they point out the obvious. This is assuming oil prices will stay at $40. I said, no. This is assuming that I don't know what will happen to oil price in the future, that today's price is what I have. This is the value. It's a conditional. So if you're saying it's a conditional valuation, you're absolutely right. You know what I mean by conditional valuation? It's the value of Royal Dutch, conditional on the price being 40. And if I ask you a question, an obvious question, you can give me an obvious answer. If the oil price is higher, what will happen? Oh, the value will be higher. The oil price goes lower. That's telling you nothing. Could the oil price change in the future? That's kind of a stupid question. Of course it will. The only problem is I don't know in which direction and by how much. And that's not really true, because I have a history of oil prices. I can't tell you in which direction, but I can at least get a sense. So here's what I did as a final piece. I took the oil price and I made a distribution. This is a suggestion we got at the start of the class. I just looked. How did I get the distribution? I have actually traded oil prices that I went to Bloomberg. I downloaded them, and you can actually, if you use Crystal Ball, actually based on historical data, create a distribution. So that was the first step, an oil price distribution. So you know how simulations work, right? I go in and pick a number out of the distribution. I get an oil price. That price could be 62. It's a number out of the distribution. What's the next step? I have that regression that links the oil price to revenues. You have to do that, because without it, the simulation breaks down, right? I have to connect oil prices to something that the company does that's operating. So I took the 62, I came up with revenues. With $62 oil prices, the revenues would be $237 billion. I worked through and valued Royal Dutch. I came up with $55 per share. Then I read it again. This time, the second go around, I get a $27 oil price. I get a much lower revenue, much lower earnings, much lower cash flow, and my value is only $27. And I do this over and over again. You see this output at the bottom? This was with 10,000 simulations across the board. I have valued Royal Dutch. I know the numbers somehow too territory. The median value across all of my 10,000 simulations was roughly $39. Why? Because I built my distributions around, or 40, wherever it is, pretty close to what my original value was. Oh, there's the median's right there, $37. Pretty close to my value that I got with my base case. Why? Because all my distributions were built around that base value. You think, so why waste your time? If all I took out of the simulation was the average or the median, it's a waste of time. But I get the whole distribution, right? So let's say the stock is trading at 41. What else can you tell me with the distribution that you couldn't have? If I just given you the base value, you could have said it looks overvalued, don't buy it, right? But now you can give me more information. You can tell me what the likelihood is that it's undervalued. Just count the number of outcomes below 41. If you say, what's my best case outcome, I can point to the, you see, it saves all those scenarios we run after valuation, best case, worst case, it's all in the simulation. And I actually find these simulations useful for decision making on one additional aspect. I remember valuing Twitter, this when it hit 27. I did a valuation of Twitter and I came up with a value of roughly 27. And I bought it. You're saying, why would you buy it if the value just hit the price? Because I did the distribution, and the tail of the distribution for Twitter went way out into the future in terms of positive outcomes. I mean, the expected value is already, but you see what I'm getting? I'm getting a stock that is fairly valued, but I'm also getting a stock where if I hit it, you're going, remember they talk about 10 baggers in investing a stock that goes up? The distribution says this is a stock. So in other words, if I have two stocks, both have fairly valued, but one has a symmetric distribution, the other has its tails, I would take the distribution with the tail because it's called optionality. Basically, I'm getting that upside that I could not have got by just running one expected value. So I love Crystal Ball. It's actually a great add-on to Excel spreadsheet. So try it out because it'll give it. So let me go back and cover one segment that I missed, which was valuing companies with intangible assets. So this is back on page 331. I kind of skipped it because I went to commodity companies. Let me come back to it. So you're a company with a pharmaceutical company or technology company. Let me go through the questions. When I say, what are your cash flows from existing assets, you show me your financials. I take a look at the financials and I have trouble. You know why? Because the accounting in intangible companies like this is screwed up. Your biggest capex is not in your statement of cash flows, it's in your income statement as an operating expense, as R&D. When I look at your book capital to see what kind of return on capital you're making, the book capital is understated because your biggest assets are the books, and I ask you what's your value of growth. If I take the stated numbers in accounting, I get a very skewed vision of your company. The problem in valuing companies with intangible assets is not that we don't know what to do, but the raw data we're provided from accounting is messed up. So we talked about what we need to do with these companies. We said, with these companies, we've got to fix the accounting inconsistencies. And it's not just pharmaceutical companies and technology companies, R&D. With consulting firms, it's recruiting and training expenses. With consumer product companies, you could argue that some portion of advertising is like this. So you could argue that this is a problem that's, I would say 80% of companies have an accounting problem now because they don't fit the mold of traditional manufacturing companies. So with Amgen, we talked about what to do about R&D. In fact, the technique we use with R&D is what we use for any other expense like this. We said you got to capitalize R&D. I know this is a throwback to quiz 1, but remember how we capitalize R&D. We estimated an amortizable life for R&D. Then we got and collected the R&D expenses for that period, and then we computed both an amortization and an amortization. The reason we did that, and I said this then, but I would re-emphasize it, is not to change the free cash flow, because if free cash flow doesn't change when you capitalize R&D, It's to get a sense of what kind of company is this. Is it earning a high return on capital or a low return capital? And you can see how the numbers play out. With my net income, my book equity, my return on equity, the numbers are affected by my R&D as it comes in. My return on equity, which was 23.5% if I trust the accountants, drops to 17.75%. My return on capital is 25.44% if I trust the accountants, down to 19.65%. It's still a good return, but it's not as good as I thought it was. In fact, if you use my Excel spreadsheet, you can very easily see the effect of this by changing the yes on the R&D to no. Because the minute you say no, it'll just go back to the traditional accounting, and you can see how much it affects your value. So let's see how this plays out in the value of Amgen. So this is Amgen valued using my definition of accounting numbers. So basically it does the R&D capitalized. So I'll cut to the chase. Because I capitalize R&D, my reinvestment at Amgen jumps by almost 2.2 billion. The traditional net capex at Amgen is only 255 million because accountants define capex and depreciation very strictly. I add the 2.2 billion. I also added acquisitions because that's another way of growing. So I'm changing the accounting to reflect what I'm trying to do in valuation. They have a huge reinvestment rate and a great return on capital. That became the basis for my story. And my story, at least in 2007, was a status quo story, where more of the same. They would continue to reinvest a lot, not as much as they did in the most recent year because the acquisitions will have to be smoothed out, and they will continue to reinvest well. When you tell status quo stories about healthcare, you've got to be careful, because I couldn't have done this in 2012 when healthcare reform. Somebody who did United Healthcare here? You know? And one of the cautionary notes I did, I am a United Healthcare subscriber and an investor in United Healthcare. But there is, I said, a scenario you should remember, which is Medicare for all is now on the table. You know, if you assume there's zero chance of it happening, of course, Medicare for all is the death knell for United Healthcare, right? Medicare for all basically means that your business is gone. If you're United Healthcare, you're sitting there praying, so please God, don't let Bernie Sanders become president. You know? But that's, and I'm saying right now, when I value United Healthcare, I can't assume that probability is zero. Okay? It could be part of the platform of one of the two parties. I mean, it could happen. It's clearly much more of a possibility now than it was 3 years ago. But here I'm assuming more of the same, because it was 2007. And with that more of the same story, the value that I got was $74.33, which was much higher than the stock price. So it was an undervalued company with R&D capitalized. So after I finished this, I had a question: how much did capitalizing R&D make a difference? Because it was work. I said, was it worth the work? I mean, maybe the value I'd have got would have been 73.53 with the accounting. Am I just running in place? So I turned off that switch. As I said, it's very easy, my valuation. And here's what I saw as happened to my value if I went back to convert. So this is what I got with my capitalized R&D. That's what I got when I chose to go with the accounting numbers. I got a value that was almost $30 or more than $30 lower. So when I capitalized R&D at Amgen, I made the value jump almost $32. And I think this is a good trick. I got a low value in my stock. I'll just capitalize R&D. This is not always going to be true. With Merck, I actually valued the company the same way, and then I turned off the R&D switch there. And guess what happened there? It goes up. When I capitalized R&D, the value went down. So what's the difference between Amgen and Merck in 2016 that caused the R&D capitalization to have two opposite effects? Yeah. In other words, why do we capitalize R&D? Because we want to bring R&D to the level of other investments and ask, is it a good investment, right? It's not, because then you're lost in the mechanics. Here's the way to think about it. When I capitalize R&D, I now have a capital value. I can ask the question, what kind of return on capital am I making on R&D? Amgen earns a 25% return on capital on R&D. So when I capitalize R&D, I'm saying this is good, do more of it. Your value went up. Merck has earned a 2% return on capital on R&D. So when I capitalize R&D, I'm seeing the real Merck, and it's not pretty. It's like Beauty and the Beast or Jekyll and Hyde or whatever transformation you want to get. Whatever transformation makes you ugly, I say, you've been wasting money. I didn't realize you were wasting money because I was looking at net income, which hides this fact. This brings it on the table, and that's why we go through the trouble of capitalizing these expenses, is to get a clearer sense. We're taking the mask off and saying, what kind of company are you? And that's what the effect on value is. Yeah.
If you're doing something like Biogen, where they just had aducanumab, like,
So basically, when that,
would you just take out?
yeah, that would be unfair. It's not bad R&D that creates. This is always a risk with a pharmaceutical company, right? Because with a drug, it's got to go through the testing process. When you have the testing process, by the time they get to the third stage, usually the probabilities are up at 94, 90. This was uncommon, but it can happen to anybody. It wasn't that they didn't do their R&D. It's just an actual testing, because you really don't know whether a drug works. You could have it work great in a lab on rats, and then you discover human beings are not quite that similar to rats, and it doesn't work as well. So I think that, to me, this is a chalking up to, this could happen to anybody. If it happens on the next 3 drugs as well, then maybe we should get together and talk about what kind of, but I wouldn't be too quick to pass judgment on Biogen, just like I wouldn't be too quick to pass judgment on Boeing about the 737 MAX. My point is there, but for the grace of God, goes any other aerospace company, because you have this incredibly I'm supposed to fly back to California tonight. You get on a plane, you don't want to think about how many things have to go right for you to actually get to your destination. You're up in the air, 30,000 feet, in this tube with all these, I don't even want to think about it, but the reality is, this is something that could happen to any of the, right now it's Boeing, and everybody's piling on saying it's because they didn't do this, they didn't do that. And you could blame, there probably things they could have done better, but the reality, this could be Airbus, this could be Embraer, this could be Bombardier, it could be any of them. So every company is entitled to a mistake. But when you're a company like Deutsche, after the 74th mistake, you're saying this is not a mistake. The whole company is a mistake waiting to happen. You know, then you're stepping back saying, I'm not cutting you any more slack. The game is over for you. Yeah. So now let's talk about the final piece of this class. This is a chart you saw at the start of the class. Remember I said, make up your mind. Are you valuing something or pricing something? And I told you what drives value. Cash flows, growth, and risk. And we've spent the last 16 sessions talking about cash flows, growth, and risk. But we also know what drives price. It's demand and supply. You're saying, shouldn't demand and supply be driven by cash flows, growth, and risk? By fundamentals, yes, they might play a role, but they're also driven by mood and momentum and all kinds of other things that we don't control. In fact, all of behavioral finance is about pricing. It's not about valuation. It's about why prices can be different from value, because some human emotion takes over. So let's talk about how we price things. I moved here from India. My wife grew up in California. When we married, she didn't realize I was going to end up in New York. So we ended up in New York, and she never liked it. And I didn't care for it, but I lived with the snow, but she absolutely hated it. So it's always, she's always, and I gave her an opening about, I think, 4 or 5 years ago. So after a snowstorm, and I went out. This is one of the things you forget about when you live in an apartment, is the snow doesn't disappear on its own. You actually have to walk out with a shovel. And so I got up. It's one of those horrifically, the snow that's heavy and wet. It took me like 3 hours. I finished shoveling the snow. I come into the garage. I throw the shovel into the side of the wall. I think I made a big hole in the wall. I walked into the house and said, "Hon, we've got to get out of here." She must have been waiting for this moment for 30 years. She was on the computer like in seconds saying, "I'm going to look up houses." And for whatever reason, she picks the most expensive part of the most expensive state in the country to look at. She picks La Jolla. This must be a hut in La Jolla. How do I know there are only 6 numbers in the price? I mean, La Jolla, anything less than $1 million, you must be in a garage or a little underground bunker. I don't know what it is. But let me ask you a question. How did this nice lady, Lisa Padilla, attach $995,000 to the house? Do you think she did a discounted cash flow valuation of the house? I don't think so. So what did she do? She looked at other houses that had sold in the neighborhood. She adjusted for the fact that this house had a bigger backyard and an extra bedroom or lack of it. And she did some pricing. You're saying those unsophisticated realtors. Okay. Let's pick up a sell-side equity research report. There's a company there. I've hidden the name of the investment banker to prevent them any embarrassment. But let's see how the equity research report goes. He says buy the stock. You know what he was basing it on? He said its PE ratio was lower than the PE ratio of these 15 other companies that look just like it. How is it any different from what the realtor did? In fact, who do you think is on more solid ground? The realtor, when she put the $995,000 by finding 6 houses like mine, or an equity research analyst who claims to have found 15 companies just like Microsoft and tells me Microsoft is cheap relative to these 15 companies. I think the realtors are much more solid ground. It's easier to price a house than it is to price stocks. It's easy to price a ticket at New York. I mean, take stock. Have you ever played, have you used SeatGeek? SeatGeek is this comparison site. You go by so if you want to buy a Yankee ticket, I don't think you want to do it right now. They look pretty catastrophic as a team. Now, you can go by section, check out the prices, and they actually classify deals by great deals, good deals, awful deals. You're saying there must be some guy sitting there doing these. You know how they do it. They compare the prices within the section, and if your price is much lower, and they have a percentage amount, they classify as a great deal. They're doing the equivalent of pricing. So when we think about price and value, we're thinking about 2 different processes. In value, we're thinking about the business, its cash flows. And pricing, we're thinking about other people and what they pay for it. So let me at least set up the process. These are the 4 questions we asked when we thought about what is it that drives the value of a company. Starting today, we're going to change focus. We're going to look at pricing. And if you look at what drives pricing, here are the things that drive pricing. The first is mood and momentum. There was a study that looked at soccer-crazy countries and looked at what happened to stock prices in these companies after they lost a major game, a World Series game, a European Cup game. Let me ask you a question. Do cash flows, growth rates, and risk change if Brazil loses to Argentina? No, but they found consistently that the day after the loss, stock prices were down like 3.5%. Why? Because people came in a shitty mood and said, sell everything. I don't care what the growth is, sell, 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 sell. You're saying, but that makes no sense. It's pricing, it's mood and momentum. Second is liquidity is a big factor in pricing, right? So the third is pricing is driven by incremental information, small pieces of news that by themselves, you say, what? I still remember about 5 years ago, I'm sitting there watching the Apple stock price on the computer, which had almost 7, and it drops like $18. It loses like $7 billion in value. So what happened? So I started digging, and it turns out that somebody in Shanghai, we don't even know whether he was in Shanghai, claims to be in Shanghai, claiming to be outside, this is where a new iPhone that had come out, had tweeted that that was the day the iPhone, there was nobody waiting outside. That's the extent of the news. That he's outside the Apple store and there's nobody else standing in line for this new iPhone. That translated into like $20 billion in lost market cap because nobody's standing outside the Apple store in Shanghai and it's the first day. That must mean this is a terrible iPhone update. This is the end of the store. That's the kind of incremental information, small pieces of news. And finally, it's a lot of crowd thinking, right? If everybody else is buying. Remember the old Keynesian saying that the stock market is a beauty contest where your job is not to assess who's the best looking person on the stage? Notice how I avoided all sexist language while I was doing this? No. So it could be men, it could be women, it could be pigs, dogs, whatever. Okay? You don't care about what you think, you look at the other judges because that's what pricing is. You're not looking to see what Lyft is worth, you're looking to see what other people think Lyft is worth. It's a different mindset. I'm not saying it's a worse mindset or a better mindset, it's a different mindset. So when we start on Monday, we will start to talk about pricing and applying pricing in the context of value. But there are a few pages left on this packet, I'll do those, but then we're going to be in packet 2. So see if you can bring packet 2 to class with you on Monday.
whole components of oil, like their revenues and their prices seems to be highly affected by the semiconductor prices that are like exchanged on the direct thing.
Yeah.
So I was wondering like if I could look at that. But the information isn't so available.
If you want, like building a distribution around this and doing something with the oil prices. The problem is, first, you don't have a market price for the semiconductor. Unless you get futures in semiconductor chips, I don't think so. So it'd be more difficult to get the raw information. Second, I think you might be asking for more trouble than it's worth, because the relationship between the price, even though it affects, it might not be as strong. It might be only 30% R squared or 25% R squared, which means there's a lot more noise in the process. So if you're going to build a simulation, build it across, not just so you can build a full-fledged simulation on any valuation. It doesn't have to be a commodity company, right? Anytime you feel uncertain about an assumption, you can. In this case, if you want to link up your forecast to something more fundamental, like semiconductor prices, you can do that.
But not so recommended.
I don't think it's going to help you with that.
Okay, thanks.
So the budget, how would you take into account that loss? Like, would
Oh,
you
it's going to be an actual dollar loss. Basically, it'll mean that there's going to be real money that Biogen, because when you looked at the forecast for Biogen, a lot of the growth was built in the presumption that the Alzheimer's drug will come online pretty soon. So basically, it'll be a before and after valuation. Your revenues, your margins will now be lower without the drug, because it was going to count for like 20 to 30%. This wasn't a small drug. It was going to be a blockbuster drug and making a big difference. So you think in terms of capital budgeting, it's almost like the incremental effect is lower cash flows going forward because you no longer have the drug. And here's the worst thing. They invested so much time and energy in developing the drug that the pipeline is pretty dry after this drug. So it's not just that they don't have a drug, but now that they have nothing in the pipeline that's near to being ready to provide even a portion of the money back. So they've created two consequences. One is lower revenues and cash flows, and second, a pretty empty pipeline, which means there's nothing coming out, which effectively translates into lower cash flows, lower growth, low value. So if you valued Biogen today versus 2 weeks ago, that would be the big difference.